Tightening is the process of raising interest rates and reducing the supply of money in an economy. It is usually done by central banks to control inflation and stabilize the currency. Tightening can have a significant impact on the Eurozone peripheral bonds, which are the government debt securities issued by the countries on the edge of the Eurozone, such as Greece, Italy, Spain, Portugal, and Ireland. The impact of tightening on the Eurozone peripheral bonds depends on several factors, such as the pace and magnitude of the rate hikes, the economic and fiscal conditions of each country, the market expectations and sentiment, and the policy response of the European Central Bank, ECB. Generally speaking, tightening can have a negative impact on the Eurozone peripheral bonds, because it increases their borrowing costs and reduces their demand. Higher interest rates make it more expensive for the peripheral governments to service their existing debt and to issue new bonds. Lower money supply reduces the liquidity and availability of funds for investors to buy peripheral bonds. As a result, the prices of peripheral bonds tend to fall and their yields tend to rise, reflecting their higher risk and lower attractiveness. However, tightening can also have a positive impact on the Eurozone peripheral bonds, if it signals a stronger and more stable economic outlook for the Eurozone as a whole. Higher interest rates can indicate that the ECB is confident about the growth and inflation prospects of the Eurozone, which can boost investor confidence and appetite for riskier assets. Moreover, tightening can also reduce the pressure on the peripheral governments to implement fiscal consolidation and structural reforms, which can improve their fiscal sustainability and creditworthiness. Therefore, it is important to analyze the impact of tightening on the Eurozone peripheral bonds neutrally, taking into account both the positive and negative effects. A neutral analysis can help investors to make informed and rational decisions about their portfolio allocation and risk management. A neutral analysis can also help policymakers to design appropriate and effective measures to prevent financial fragmentation and ensure financial stability in the Eurozone. In this section, we will look at how the recent tightening of monetary policy by the European Central Bank, ECB, has affected the bond yields, spreads and risks of different peripheral countries such as Greece, Italy, Spain, and Portugal. The ECB has been gradually raising its key interest rates since September 2022, when it announced a 50 basis point hike to 0.75%. Since then, it has raised rates by another 25 basis points in December 2022 and March 2023, bringing the deposit rate to 0.25% and the main refinancing rate to 1.25%. The ECB has also confirmed that it will end its Pandemic Emergency Purchase Program, PPP, by June 2023, and that it is working on a new instrument to prevent further widening of sovereign spreads in the Eurozone. The tightening cycle has been driven by the ECB's assessment that inflation pressures have become more persistent and widespread in the Eurozone, as the economy recovers from the pandemic shock and faces supply bottlenecks and higher energy prices. The ECB expects inflation to average 2.8% in 2022 and 2.1% in 2023, well above its target of below but close to 2%. The ECB's hawkish stance has had a significant impact on the bond markets, especially for the peripheral countries that have higher debt levels and lower credit ratings than the core countries. The tightening cycle has pushed up the yields on peripheral bonds, as investors demand higher compensation for holding riskier assets in a rising interest rate environment. It has also widened the spreads between peripheral and core bonds, as investors perceive a higher risk of financial fragmentation and debt sustainability issues in the Eurozone. Let's take a look at some data to illustrate these effects. The following table shows the changes in 10-year government bond yields and spreads for Greece, Italy, Spain, and Portugal from September 2022 to May. Country: yield change, BPS; spread change, BPS. Greece, plus 153, plus 128. Italy, plus 97, plus 72. Spain, plus 66, plus 41. Portugal, plus 59, plus 34. As we can see, all four countries have experienced a significant increase in their borrowing costs since the ECB started tightening. Greece has been the most affected, with its 10-year yield rising by 153 basis points to 4.23%, and its spread over Germany widening by 128 basis points to 3.78%. Italy has also seen a sharp rise in its yield and spread, reaching 2.67% and 2.22% respectively. Spain and Portugal have fared slightly better, but still face higher yields and spreads than before. The rise in peripheral bond yields and spreads reflects several factors. First, there is a general repricing of risk across global markets, as central banks around the world withdraw stimulus and prepare for higher interest rates. Second, there is a divergence of economic performance and fiscal outlooks among Eurozone countries, as some recover faster and stronger than others from the pandemic shock. Third, there is a concern about the future of the ECB's support for peripheral bonds, as it phases out its PPP and introduces a new facility with unknown details and conditionality. The higher yields and spreads pose several challenges and risks for the peripheral countries. On one hand, they increase their debt servicing costs and reduce their fiscal space for stimulus and reforms. On the other hand, they raise their vulnerability to external shocks and market turbulence, such as a potential spillover from Brexit or a geopolitical crisis. Moreover, they create a negative feedback loop between sovereign risk and banking risk, as banks hold large amounts of domestic government bonds on their balance sheets. To mitigate these challenges and risks, the peripheral countries need to pursue sound fiscal policies that ensure debt sustainability and credibility in the medium term, while supporting growth and recovery in the short term. They also need to implement structural reforms that enhance their competitiveness and resilience to shocks. In addition, they need to rely on the ECB's continued support for their bond markets, through its new facility and other existing tools such as its Asset Purchase Program, (AP), and its targeted longer-term refinancing operations, TLTROs. In conclusion, we have seen that the recent tightening of monetary policy by the ECB has had a significant impact on the bond yields, spreads and risks of different peripheral countries such as Greece, Italy, Spain, and Portugal. The peripheral countries face higher borrowing costs and lower fiscal space than before, as well as higher vulnerability to external shocks and market turbulence. To cope with these challenges and risks, they need to balance fiscal discipline with growth support, pursue structural reforms, and count on the ECB's support for their bond markets. The tightening process of the Eurozone bond market refers to the rise in bond yields and the reduction of bond purchases by the European Central Bank, ECB. This process reflects the expectation of higher inflation and interest rates in the Eurozone, as well as the gradual withdrawal of the emergency stimulus measures that were implemented during the COVID-19 pandemic. The tightening process has different implications for the peripheral countries of the Eurozone, which are Portugal, Ireland, Italy, Greece, and Spain. These countries have relatively weaker economies and higher public debt levels than the core countries, such as Germany and France. The main drivers of the tightening process are the improving economic outlook, the accelerating vaccination campaign, and the hawkish signals from the ECB. The Eurozone economy is expected to grow by 4.8% in 2022 and 2.6% in 2023, according to the latest ECB projections. The vaccination rate in the Eurozone has reached over 80% of the adult population, which has allowed for the easing of lockdown restrictions and the recovery of consumer and business confidence. The ECB has announced that it will end its Pandemic Emergency Purchase Program, PPP, which was buying €80 billion worth of bonds per month. By March, it has also signaled that it will start raising its key interest rates, which are currently at record lows, from late 2022 or early. The main challenges of the tightening process are the uneven impact on different sectors and regions, the uncertainty about the future course of the pandemic and its variants, and the potential financial instability and social unrest. The tightening process may widen the gap between the more resilient and dynamic sectors, such as technology and manufacturing, and the more vulnerable and lagging sectors, such as tourism and hospitality. It may also increase the divergence between the core and peripheral countries, as the latter have less fiscal space and more debt vulnerabilities than the former. Moreover, the tightening process may face unexpected shocks from new waves of infections or mutations of the virus, which could derail the economic recovery and require more policy support. Finally, the tightening process may trigger financial market volatility and political backlash, especially in countries where public discontent and social inequalities are high. The peripheral countries differ in their exposure and resilience to the tightening process. Among them, Ireland has been performing better than its peers, thanks to its strong export sector and its low reliance on tourism. Ireland's bond yields have remained low and stable, even lower than some core countries like France. Portugal has also shown some signs of improvement, as it has benefited from EU funds and structural reforms. Portugal's bond yields have converged towards those of Spain, which is considered a benchmark for peripheral bonds. Spain has faced some challenges from its high dependence on tourism and its political fragmentation. However, Spain has also received substantial EU funds and has maintained a solid growth momentum. Spain's bond yields have risen moderately but have remained below those of Italy. Italy and Greece are the most vulnerable peripheral countries to the tightening process. Both countries have very high public debt levels, over 150% of GDP, which make them sensitive to changes in interest rates. Both countries have also suffered from low growth potential and structural weaknesses for a long time. Italy and Greece have seen their bond yields increase significantly since late 2021, reflecting their higher risk premiums. However, both countries have also taken some positive steps to address their challenges. Italy has formed a stable government led by Mario Draghi, a former ECB president who has boosted market confidence and policy credibility. Italy has also received the largest share of EU funds among all member states, which could help boost its investment and productivity. Greece has also benefited from EU funds and debt relief measures from its official creditors. Greece has also implemented some reforms to improve its fiscal position and competitiveness.